Hello guys, what's up? Welcome to Average Day Trader. So today I want to talk about a couple option strategies that I've been running in my live Robinhood account. So I'll just refresh it. It's not a screenshot. So cool. Today was a great day. Started off with a little scare where it dipped down, but overall the rest of the day looked solid. Cool. So this is my own portfolio. I have about 30,000 in there. And on the right, you can see I have a couple of covered calls that I'm selling. So these are in January and a couple in one in February and one in June. But all right, for this video, I want to talk about a strategy called cash covered puts. So for that, I will show you an example Groupon. So recently I did run a cash secured put on Groupon. So just scrolling down, I will show you the history here. So December 31st, I tried initially to sell it for 10 cents. So I tried to get $10 and I canceled that because I wasn't getting filled. Tried it twice. For a third time, I just went down to 5 cents. So I got the $5. So 2 contracts at $5. And I did get my $10 as a credit. So before I show you how to actually execute a cash put, I'll show you why I chose Groupon. So Groupon, just looking at, say, the 3 months, I noticed that this had its ups and downs, but right now it's in the up, and it hasn't really gone below a certain level. Maybe the 1 month is better. Yeah, so for the past 2-3 weeks, it really hasn't gone below to like 11.75, 11.85. Yeah, so my strike price was at 11.5. So my guess here was that it's not going to go down to 11.5 or less. All right, so to explain it better, let's just go to options and I'll show you here. So when you're here in Robinhood, you got to select put first and then the sell. And let's change this to 1 week out. Cool, right now the stock is trading at $12.06. So say I was going to sell it again for the coming next week for 11.5, I would be getting a credit of $15. So when I sold it, I think I sold it on Thursday or Friday, so I didn't get the full weeks, which is why I didn't get the 15. I only got 5. Cool. So for example, here, all you want to do is you just have to click the plus sign to create a strategy. And Robinhood is great. It actually shows you the visualization of the option here. So before that, I do want to show a couple things. Bid means how much is someone willing to pay for this option right now. It's 15 cents. And there's about 12 people at this price point. So there could be more behind them at 10 cents, 5 cents. Ask means how much are sellers looking to sell their contract for. So there's sellers looking to sell it at 20 cents for the cheapest. And there's 14 at the moment. And mark just means the midpoint of that. So the middle of 15 and 25. 20, it's 17.5 cents. Cool. And we can also see, I do like to see the last trade. So last trade, it was 28 cents. And volume, you want to pick stocks with some volume, or at least options with some volume. So that's there as well. And the other thing you want to look at is delta. So delta, it just means like the probability of this actually happening. Delta and this chance of profit, they're similar, they're related. So the chance of this, or you being profitable, is 76% here. Cool. So looking at the graph here, the way this covered put works is as long as Groupon stays above the strike price you chose, so in this example 11.5, that means that the person that bought this contract from you means that they can sell it to you for 11.5. So if the price goes down to, let's say, $11.20, the seller can just execute the contract and sell it to you for $11.50 rather than the market price of $11.20. Cool, that makes sense. But if the market price is, say, $12, then it doesn't make sense for the seller, or I mean the buyer who bought the contract from you, to sell it to you and execute the contract for $11.50, because they can just sell it in the open market for $12. Cool. So all it means is that we're taking a bet saying the price for a Groupon will not go below $11.50. That's all it means, basically. And for us to take that risk of, if it does go below, we are getting credited, or we're getting paid $15 from the person that buys the contract from us. And here we can see the break-even point. So although the strike price we have to buy at is 11.5, since we are collecting $15, that means 15 cents minus 11.5 is 11.35. So effectively, we've gotten it for $11.35, because we already get this $15 right away as soon as the contract is purchased. Cool, that makes sense. So now, why do I like the strategy? So since it's a weekly, we can actually run it every week. So say week 1, we run the strategy, nothing happens, Groupon is still just at $12. Cool, the contract just expires, nothing happens. We keep the $15 and we move on. Next week comes, we sell it again for $15, right? And nothing happens. So we keep the $15 and we move on. So third week happens, and suddenly the price actually drops, and now we're at $11 and say 40 cents or 30 cents. Cool. So that means that we have to buy for $11.50, and that is granted the person executes the contract. So say he does execute it, he or she, and then we buy it at 11.50 cents. So now the market price is 11.30, means that we bought it for 20 cents or $20 higher. So technically on the stock, it will say we're down $20 because we bought it at a higher price. But remember, for 3 weeks, we've collected $15. So we've collected about $45 right there. So even though the stock will say we're down $20, we're actually not down $20. We're up 45 minus 20, which is $25. Cool, that makes sense. So this strategy is great as long as you can keep doing it consistently, and you don't get assigned, meaning you have to own the stock. But even if you do own the stock, it's not the end of the world, right? Because the more times we get to collect this premium, the lower our actual cost that we buy it for comes out to be in the end. Cool. So now that makes sense, let me just show you how this will look like in Robinhood. So once we select it, right, it's going to show this. If this is fine, it makes sense, and you're happy with the price, the strike price, and the 1 week out, we just hit continue. So then here we say how many we want to do. Let's say we want to do 1, and then remember the bid and the ask. So this is if you want to get filled right now, just sell it right away. We have to do it at 15. So there's a buyer already waiting for 15 cents, but at the moment the best seller is 20 cents. So we can go down and collect less money if we want to execute this contract right away. Or we can just wait for 20 cents, it doesn't matter. And last trade was at 28 cents, so we could possibly get 20 or even higher. So for simplicity's sake, let's just say we sell it for 20 cents. And like I said earlier, we'll collect $20 as a credit. But, this is just for one contract. So if you do, say, 10 contracts, you're pretty confident, then technically you can collect $200 for the week. Cool. So we do one contract, 20 cents, good for a day, and everything's the same. Our break even actually goes down because we're not doing 15, we're doing 20 cents now. All right, let's review the order. And now the interesting part is we see this thing called collateral. So remember, this put means that the buyer who bought the put from you, they can sell it to you for this price of $11.50. Right, and if they can sell it to you, that means that you have to be able to buy it. So you need that money to buy it, which is why Robinhood has this thing called collateral. All right, sorry about that. I had to refresh my window, so now it's dark mode Robinhood, but everything's the same. Cool. So since I don't have enough buying power, I'll have to either sell some stocks, or I can just deposit some money until I get up to here. Cool. So for now, I won't deposit any funds. And I will show you an example what happens when you actually get assigned and now you own the stocks. So that's actually not the end of the world. So let's close these out. Now we're back to square one. All right, so now say you own the stock. You've been assigned and now you own the stocks. You buy the stocks, right? You have 100 shares of Groupon. You can either sell it at the market price and maybe take a little bit of loss, but also not so much of a loss because you've already collected premium. Or the other interesting case is then you can just start selling covered calls because you re-own the shares. So say you don't really want to hold it for too long and you don't mind making a quick little profit on it. So then we just said sell the covered call for that's like one strike above it. In this case, if you were at 1150, then you'd probably just do 12. For some reason, there's no. Oh, it's because that is the price. So there's. It's a little weird. Maybe there's no buyers. Yeah, there's no bid on it yet. Okay. So just imagine one leg up, and you'll be collecting some amount of premium, right? So then now, when we're on the covered call, what happens is if the price goes above it, and someone buys it from you, they get to buy it for this price of 1250. But again, you get to collect premium while that happens or has not happened yet. Or even if it happens or not, it doesn't matter. You still collect the premium. So yeah, that's what you can do. And if you just want to hold the stock, you can just hold the stock and sell covered calls. Preferably that's a delta less than 20. The lower this number, the safer it is. It just means less probable of the stock hitting that price. So, if you really want to be safe, you can probably go all the way up here. But you will have to get a much less premium because the chance of this happening is a little less, at least for the stock. Cool, so that makes sense, right? All right, now I just wanted to show you guys an example of how you would screen for stocks that's good for cash secured puts. So I'm going to open up this website called FinViz. So it's right here, FINVIZ. I'll also put it in the description. This is a great free site where you can screen for stocks. So I'll show you a filter that I did here. It's not, you can always mess with it, but this is just something that I tried and seems like a good one. So first up on the descriptive tab, we're going to put the price depending on your portfolio. If you have a small account, for example, we'll do 10 to 20. That seems to be a good spot for stocks in this price range on the lower side. And then we'll do average volume at least over 1 million. That's my preference. You want something that has volume and is not illiquid. And then we do current volume, same thing. And of course, you want to make sure it's optionable. Otherwise, you can't sell covered calls or any other option strategy. And then lastly, just a simple technical. So you can either do you can do 200-day simple moving average. You can do 50, 20. I do like doing this. So this is 52, meaning for the whole year. So from the 52 week high / low for the whole year, or the past 52 weeks, I should say, it's 50% or more above the low. So the trend is up, right? And you can see here on American Airlines, you can see that the trend is generally up for the past 52 weeks. Or in this preview, it only shows a few months, but you get the idea, right? So yeah, at least the recent trend is up. Cool. So now if you did the other way, if you wanted to look at stocks that were kind of trending down slightly, this might be the same, but yeah, I was messing around with this and I didn't really see too much of a difference, but this one just seemed like the stocks were trending down in the recent weeks. So cool, that's how you do it. And then go back to here. So let's say you pick the number one, the one that shows up here just by alphabetical, so it's not number one, but say it's AAL, that's American Airlines, and let's pull up American Airlines. I pulled it up earlier. So what I'll do is I'll look at American Airlines, look at like the past couple weeks, see where generally it's floating. So if I was pretty sure I didn't want to buy the stock outright, I can do that. I can wait for the price to come down to a certain level that I like it at. Let's say it's pretty inflated up and it's making a big run, it hasn't done a pullback, then I might want to wait for that. So just doing a quick scan, 1650-ish and 1760-ish seems to be the current high and low range on average. Previously it was 1488, so it was trading at around, it's definitely seen 11 to 18 is what I would say the range is on this. But in the recent weeks and months, the change hasn't been much. Like, what I'm really looking at is the high to the low, how much of a swing, how much it can swing from up and down. So about 18 to 16, so $2, not even $2, but almost $2 of a change in a week. So that just means that depending on what the time I buy it, this stock can move up or down $2, in my opinion, at least from the recent performance. Doesn't mean that that's the only case, but based on the chart. Cool. So in that case, if I like the stock, if I did want to own it, but I don't want to buy it just yet, I want a good price, a good entry price. So then I can even look for something like this one is very safe. It means that there is a 88% of chance of being profitable, meaning the price will not go down here at a probability of 88%. So maybe, I'm not in a rush. I can just sell these puts, cash secured puts. So same thing. This one is, just click that open. Bid is 6, ask is 8. Last trade is $7. So you might be able to get $7 here at for this one. So not terrible, It's like a waiting game. So the one downside is your cash is kind of stuck in the stock, right? While you're in it, because if you're doing a cash secured, if you don't want to do that, if you really don't want to buy it, then you can do something called, let's see, a put credit spread. So you can sell the higher one, the higher premium one, and then buy the lower premium one, the one leg lower. So it means that you don't really want to buy the stock, right? But you are bullish on this, saying that it's not going to go less than 15 and a half in this case. So it just means that you're selling it, collecting $6, and then you're getting you're buying for $5 the lower leg. So in this case, the max profit is $3, and your max loss is 47. The difference of whatever you made, and minus the $50 difference of you buying it and then you selling it over here. Or I might have had that the other way, but you get the point. So this might not be a good example for this one, but for bigger stocks, then the profit and loss might make more sense. But this is it's not terrible. Like if you're confident on this, the return on this is 6% return on what you're risking. So it's not terrible. You will win according to Robinhood about 90% of the time, I would say. So break-even percentage is about 9%, so 91%, 90% of the time, you should win this. So, options are pretty fun. This is another strategy you can do if you don't want to get your whole capital tied up. This would only take about, I think we can check now. Let's see how much collateral it'll take. Credit review order. So collateral-wise, it just takes $50, the difference of these two strikes. And you will get a credit for $3. So just to show an example, let's go to Tesla on a even more volatile stock where the options premiums are pretty wild. Tesla made a killing today. $31 move. Anyways, so let's say we look at the same. Let's say we were bullish on Tesla again. So just pick two random ones. This is a week out, so these are going to be pretty expensive, especially with the move like today's. So let's say, you're confident Tesla is not going to drop below 400, at least for the next week, so you can do something like this. And this is a 250 strike price difference. So I might have had this other way, actually. So yeah, in this case, with these two legs, you can get max profit of 93 and then a max loss of 157. So it's not terrible. If it's high probability, which in this case is 70%, let's say you really wanted to get something even more higher probability than that, then we'll just go down. So let's see if we're selling it here. I like the 80, anything 80 and higher is pretty solid. So if you really want to be safe, like, this is pretty far back, but let's see, sell that and then buy that. So this one is very high probability, like 90%. So you can collect a nice $17 while the max loss is 233 because of the strike difference of 250 plus the credit you're getting, I believe, is how this is getting that max loss and profit. Oh yeah, so it depends on what your price is. So if you got $20 for it, then it's that minus the 250, right? So it's not terrible. It's a high probability, and it's almost guaranteed. It's not always guaranteed, but it's almost pretty guaranteed. Like, the difference here is substantial. Tesla making a 40 point move on the week definitely can happen, but especially after big 30-point move ups to the upside, going back down, it's a little bit unlikely just to flip switch it just like that. So that's the strategy. Not cash covered, cash secured puts. And then if you do get signed, we go back and we start selling covered calls. So you can collect premiums on both sides and in both scenarios. All right, so I just to recap, you can use FinViz to find these stocks and just mess around with different filters that you like. So one thing I've been looking at is trying to hold dividend paying stocks that's not that volatile and it has options. So I'm not looking for crazy amount of premium, but I am looking for something on the safe side while that also gives some dividends, and it's more predictable, unlike Tesla or Nvidia or anything that's very highly volatile and has the options are very expensive. So cool, that's the strategy I'm running. I'll keep you guys updated on how my portfolio is working out. So far good. I did have to roll some calls, and yeah, I can show a live video on that when I do have to roll a next call. But cool, if you guys enjoyed the video and hopefully you guys learned something, if you have any questions, just let me know in the comments. I'll be pretty quick to answer and making videos. So this is not just the last video on this. I'll be making a lot of different calls. I do want to make some videos showing some good stocks. So I'll take some time to screen it and give you guys like the top 5, top 10 that I think for this month looks good for covered calls, cash secured puts, and there's a bunch of other strategies. So I'll just be going over all of them slowly over time. And you don't need to know everything, but it's fun to know what's possible, and you don't always need to pick either up or down. You can be neutral and profit on many different ways. All right, so yeah, that's it. And if you guys want to just take a look at my calls here, this is what I'm doing. I can show you guys in the meantime what I did. For example, CVS covered calls. Let's just quickly take a look at this. So I bought CVS. Let's just go to stock first. So I got CVS not too long ago. This was maybe just right in the tail end of December, so a little over a week ago. I bought it for $44.73 on a slight pullback, and so far on the stock, I've been up $231, which is not that much. To be honest, the stock only moved like $1, but I do own 200 shares of it. So I'm up 2-3%, 2.5-ish%. So on that, and I do have 2 covered calls, so I did collect 2 premiums on that. So let's take a look. So this is the 47 call, and this I have until 24th. So 3 more weeks left on this. And if at any time this gets to 47, then the stock can get away from me. So I do want to try to hold CVS. If it gets close in the area, 47, 47, I mean, I will roll this again. So just to show you history, I did roll this today, and this was a net debit, meaning I actually had to pay because the stock really ran up. But I was fine with that because yes, while I do pay 93, if the stock does get signed or reaches the 47 mark, I do get that money plus a little bit more back on the stock's appreciation. All right, cool. So that's one of the examples here, and I'll show you guys exactly what I'm doing and teach you, not just give you hypothetical scenarios. I'll try it out and show you how it works. Show you how these options work. Cool. Besides that, the only other option I'm actually holding that's not in this, it's in Webull, is I'm holding in an Apple call for 260, so all-time high. That's 3 months out, March contract. I thought I got in at a pretty good price, but Apple, the past 2 days, it's been kind of, because of the news, a little down, so I'm taking some heat on that, down about $100 on that. The contract was $500, I believe. But I do have 3 months on that, so I think Apple will make a rebound. And yeah, I'll keep you updated. Hopefully that leap works out. But alright, without the video getting too long, that's it. Any questions, let me know. If you guys enjoyed, please like, subscribe. And I love questions. Ask them. And I'll try to make sure to answer it either in the comments or in a new video. Cool. Thank you guys. Have a great day.